Silver has hit an all-time high, $50 an ounce, and the world has gone wild for it. People are rushing to buy as demand skyrockets and the supply runs dry. Prices keep climbing higher and higher every single day. But not everyone is celebrating. Experts warn that this silver surge could be nothing more than a massive bubble waiting to burst. And why do we believe that? Because in the world of finance, there is one timeless truth. History repeats itself. If we take a look at the history of silver, this isn't the first time it has touched $50 an ounce. It has happened twice before, once in 1980 and again in 2012. And both times, history told the same story. After reaching the peak, silver crashed, falling nearly 70 to 80%, wiping out the savings of countless investors. Now silver has once again reached its all-time high, crossing the $50 mark, and it's just a few days, but it has already dropped by 7 to 8%. The world is watching very closely and people are anxious. Should they buy now, hoping it climbs even higher, or should they sell, fearing there could be another crash? The main reason for this panic goes back to the history itself. In 1980, when the silver prices crashed, it took a staggering 32 years to climb back to the same level, which is in 2012. Then again, after the 2012 crash, it took another 13 years for the silver to reach today's price, which is 2025. So yes, the panic is real. People are wondering, is silver going to soar even higher, or is this another crash waiting around the corner? But to truly understand what might happen next, we need to understand why silver crashed in the past. In 1979, the price of silver was just $6 per ounce on the COMEX. COMEX is the commodity exchange market where assets like oil, gold, and silver are traded, and 1 ounce equals to 31 grams approximately. Within 1 year, silver's price skyrocketed from $6 to $50 an ounce. The reason behind this historic surge? The Hunt brothers. Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt, the wealthy sons of the Texas oil tycoon Harrelson Hunt. After inheriting their father's vast empire, in the late 1970s, fearing rising inflation and the decline of the US dollar, the Hunt brothers turned their attention to what they believed was the ultimate safeguard against currency, which is silver. Through their research, the Hunt brothers discovered something extraordinary. Globally, the annual demand for silver was around 800 million ounces, driven by industrial use in electronics, photography, and jewelry. But the supply was only 650 million ounces. That meant one thing: silver was in massive demand. Sensing an opportunity, the brothers devised a bold strategy to corner the silver market. They began investing heavily in silver futures. Now, what exactly is futures market? It's a simple system that allows traders to buy or sell huge quantities of a commodity, but only by paying a small fraction of the total value known as the margin. For instance, if you wanted to trade $100 worth of silver, you would only need to pay around $10 or $20 as margin, similar to how leverage works in today's stock markets. The commodity futures market works on a 1-month validity cycle. That means at the end of each month, traders have two choices: either sell their futures contracts before they expire, or pay the remaining balance, that is the remaining 90%, and take delivery of the physical commodity itself. The Hunt brothers chose the second option. Instead of selling their contracts, they began converting them into physical silver month after month. They stockpiled massive quantities of silver bars and stored them securely in vaults and warehouses around the world. For 9 consecutive months, they continued this aggressive buying spree. By the end of it, the Hunt brothers had accumulated over 100 million ounces of silver in physical form and held huge positions in silver futures contract. Together, their holdings represented nearly 1/3 of all the silver available in the world's non-government supply. In other words, the Hunt brothers practically controlled the silver market.
But the people who run the silver exchanges in Chicago and New York were mainly afraid that the Hunts would accumulate so much of the available silver that they could set any price they wanted.
Before the Hunt brothers entered the scene, there was already a natural shortage of 150 million ounces in the market. Then the Hunt brothers came, and their massive buying spree changed everything. They alone accumulated close to 200 million ounces of silver. This effectively removed an extra 200 million ounces from the global circulation, creating a total shortage of around 350 million ounces of silver worldwide. With demand exploding and supply vanishing, silver prices on the COMEX began to skyrocket, pushing the market into a full-blown frenzy.
But last year, as the Hunts bought more and more, the price skyrocketed, soaring from $9 an ounce to $52 an ounce, an increase of 580% in just 6 months.
But soon everyone started asking the same question. Where did the Hunt brothers get all this money from? How were they able to keep converting their silver futures into physical silver every single month? The answer was simple but dangerously clever. They bought the first month's silver future contract by paying 10% of its margin. By the end of the first month, they converted the futures contract into physical silver by paying the remaining 90%. For the second month, they bought the silver futures contract by just paying 10%, and by the end of the second month, they pledged the physical silver that they had acquired from the first month to a bank and got a loan for 90%. And using that, they bought the futures contract as physical silver for the second month. They repeated this for every single month. By pledging the silver they got from the previous month, they got the loan and bought the physical silver for the next month. They did this for 9 consecutive months, creating a powerful feedback loop that kept draining silver from the market. As a result, a massive portion of world's tradable silver was being locked away in Hunt brothers' vaults. By the end of 1979, the price of silver had exploded to around $32 per ounce, a level never seen before in history. The soaring price created a global frenzy. The retail investors, jewelers, and ordinary consumers rushed to buy silver, believing it would climb even higher. It became a full-blown silver mania, and the Hunt brothers were at the very center of it all. As silver prices soared, the impact rippled through the economy. Consumers and retailers were forced to pay high prices for jewelry, decorative items, and industrial products that relied on silver. But the real crisis was that no one wanted to sell. Recognizing the seriousness of the situation, the commodity exchange, COMEX, decided to intervene. In the early January 1980, they introduced a new set of emergency regulations known as the Silver 7 Rules, meant to cool down the overheated market and restore balance. So the rule number 1 was, traders could now convert only 500 silver futures contract into physical silver every month. Anything beyond that had to be sold back into the market, forcing more silver supply into circulation. Rule number 2. The margin requirement for silver futures was raised from 10% to 14%. That meant every trader holding silver contracts now had to pay an additional 4% to maintain their positions. For small investors and retailers, this was a heavy blow. Many were forced to sell off part of their holdings, giving the market a brief moment to breathe. But for giants like the Hunt brothers, this new rule was only a minor hurdle. With deep pockets and vast silver reserves, they continued their aggressive buying strategy, determined to keep control of the market no matter the cost. In spite of new regulations, by the end of January 1980, silver prices hit an astonishing $50 per ounce, the highest level in history. The market was in chaos and the commodity exchange had to act fast. They introduced another drastic rule. From now on, traders could only sell silver, not buy any new contracts. But even that didn't work. Most traders still refused to sell, believing the price would rise again. Silver remained frozen at its peak. Then the exchange made its most shocking move yet. Overnight, they raised the margin requirement from 14% to a staggering 40%. The impact was immediate and devastating. The Hunt brothers were holding nearly $110 million worth of silver futures, and to maintain their positions, they were forced to borrow heavily from banks just to survive.
So they changed the trading rules several times until the Hunts were forced to sell and almost nobody else was allowed to buy.
For small traders and retail investors, that was the end. They couldn't afford the new margin and had no choice but to liquidate their holdings. Suddenly, the market was flooded with silver, a massive surge in supply that sent prices spiraling downwards. As prices fell, more investors rushed to sell, triggering a domino effect that crushed the market completely. By March 1980, in just 2 months, silver prices collapsed, falling from $50 all the way down to $5 an ounce. Thousands of investors who bought silver at record high faced devastating losses.
And nobody knows how much was lost by small investors who jumped on the Hunt silver bandwagon.
The silver-related industries laid a lot of people off. There were more than 5,000 people who lost their jobs in all of that.
And the Hunt brothers, once among the richest men in America, lost everything, suffering a total loss of $1.7 billion and eventually filing for bankruptcy.
That drove the price down and cost the Hunts more than $1 billion.
The day the market crashed would go down in history as Silver Thursday. This was the silver crash of 1980, and 31 years later in 2011, history seemed to repeat itself. Once again, silver reached an all-time high, driven by global economic uncertainty, fears of inflation, and a weakening Eurozone. But just like before, those weren't the signs of true demand of silver. They were just signs of panic. And when panic faded, silver prices plunged down by nearly 80%, wiping out the fortunes all over again. In both 1980 and in 2011, silver didn't rise because it was suddenly more valuable. It rose because money was losing its value, and people desperately looked for something stable to hold on. Now it's 2025, and silver has once again reached its historic peak. So the big question returns: is the market about to crash again, or are we witnessing a new era of silver? This time, experts believe the surge isn't just about inflation or unstable economy. There is also a genuine rise in industrial demand as well, from renewable energy, electric vehicles, and advanced electronic industries that rely heavily on silver. Still, many analysts warn that much of this rise could be speculative and that once again only time will tell where silver truly stands.